The 2026 call for us is that we will continue to see resilience in the global economy, actually even a pickup in global economic activity, given some fiscal support, policy easing in the United States. And that should continue to drive markets higher. We're looking for some type of rebalancing, sector rotation even within growth, but also to broadening out to other parts of the markets, specifically non-U.S. markets as the Federal Reserve lowers interest rates.
Okay, so what non-U.S. markets do you particularly like in 2026?
Typically, the developing markets of the world perform best in an environment when the Fed is easing and when the dollar is either flat to weakening. And so, that's why so much of this is on the Fed right now and why the focus is so significant on the Fed, because a lot of these calls are predicated on the fact that we will get easier monetary policy, a steepening of the yield curve, and no additional upward pressure on the U.S. dollar. And so in that backdrop, a number of developing economies, the central banks of developing economies, can lower interest rates and produce better economic outcomes.
In the U.S. here, it's been 2025 has been, I guess the theme has been AI and what it means for everybody. Do we still play that in 2026? Do we have a different playbook for AI in 2026?
Well, the nice thing about it, I think you continue to play it, but the nice thing is you can diversify some of your portfolio into other parts of the market if you get the policy easing and a pickup in activity. And so the challenge for the last couple of years has been, it's really been an environment where economic activity has been basically flat. There's been no real catalyst to unlock value in the U.S. markets. And so in a slow growth environment, you buy growth. I don't think we give up on that trade. But if you get the pickup in economic activity that we are expecting, you should be able to participate with a better valuation portfolio. That would mean moving into mid-cap strategies, moving into more value-oriented parts of the market.
And what about private credit, which we know has been exploding? You see opportunity there in the new year?
Yeah, we do. And I don't think that, the concerns that people have with a couple of high profile names, questions about whether that was systemic. And, I went on record saying idiosyncratic. So far, so good. I don't think that the private markets are impaired as many people believe. And you're still looking at yields of, 7-8%,
exactly,
which is, probably a reasonable equity-like return, maybe even better than equity-like return over the next decade. And the fundamentals still appear to be sound.